Hello, everybody. It's John Llodra here from New Harbor Financial Group for a timely take. On this timely take, I'd like to talk a little bit about some of the recent actions in interest rates. This has been a major theme of markets and the economy over the last several months. So let me just rewind the tapes a little bit to this past October. October 27th marked the low of the stock market last year. And almost on a dime, the market and almost all markets, bond markets included, turned up very, very abruptly from October 27th. And one of the key catalysts for that was a sudden reversal, not only in the Federal Reserve's messaging on interest rates, but especially the market's perception of what the Federal Reserve was going to do on short-term interest rates. In fact, as I've talked about in several videos over the last handful of weeks, we ended up with a situation where the market was pricing in significantly more easing in short-term interest rates than even the Fed was communicating. Let me put some numbers around that. Late last year, in a Federal Reserve Board meeting, Jay Powell, the chair, communicated that the committee saw possibly in 2024 a situation where they would be inclined to start to drop interest rates after one of the most aggressive easing hiking campaigns in modern times. And the tune of the messaging was, hey, maybe we'll see maybe 0.75% drops in the short-term interest rates throughout the course of 2024. And the market took that bit in its teeth and ran with it. And to the tune of that, the market was pricing in at one point close to effectively 8 quarter-point drops in interest rates. And so the market and the Fed were at this major standoff in terms of expectations for interest rate drops in 2024. And I had commented that we here thought that the market had gotten way ahead of itself and was due for some disappointment and resetting of expectations. So it's actually quite appropriate. Here I am on February 9th, Friday, February 9th, and just not even a week ago, this past Sunday, which I think is would have been the 4th of February, if I did my math right, Jay Powell appeared on the everyday popular show 60 Minutes on CBS. And it's very rare that a Fed chair comes on to 60 Minutes. And our experience is when they come on, it's because they want to make a really impactful statement to correct a misperception or misconception on the part of the market. So I think that it absolutely was the reason Jay Powell appeared on 60 Minutes last Sunday. And in fact, his message was pretty much as follows. He basically said, virtually zero chance, very unlikely that the Fed would drop interest rates at all in the upcoming March meeting, and that at most maybe he thought by mid-year that maybe an interest rate decline would be in order. So I want to share some stats to just give you a sense for how abruptly the market repriced things. So this is a plot of the Treasury yield curve, and it basically on this axis it goes out from essentially 0 to 1 month, 2 month, 3 month, all the way up to 30 years. And you can see here, these are the interest rate levels. What you see here is an inverted yield curve in that, and this has been persistent for much of the last couple of years. Not a good sign from an economic standpoint, where the short-term rates are higher, significantly so than longer-term rates. And there's been some changes to this yield curve. But I want to show you, so this is at the end of October of last year. This is the day that the S&P and the bond market, I think, as well, bottomed last year. And if I pin that date and compare it to, for example, where we were at the end of October, I'm sorry, at the end of December, you can see this big gap had opened up. Basically, the market by the end of December was pricing in quite a bit of reductions in interest rates compared to that reference October 27. That's a very big move. So very, very big gap there. So let me zero out these here. And I want to show you the response to what happened when Jay Powell talked. So if I look at where interest rates were, say, a week ago on February 2nd, I'm going to pin it and then compare that to where we are today. And you can see here, the market has reset its expectations in terms of interest rates. That's why the green line is above the red line. But even more profoundly, let me take you to what's called the CME FedWatch tool. And this is basically a tool where we can kind of see what the market was pricing in. So at the end of December, the market was pricing in about an 88% chance that the Fed was going to drop to some degree come the March meeting. So here we are, the March meeting right here. And this shows for, so again, the end of December, it was about an 88% chance that the Fed was going to, the market perceived an 88% chance the Fed was going to drop rates by at least 1/4% or more come the March meeting. So even a month ago, you can see the probability of this right here is 60.76, and here 3.2. The sum of those two is about 63%. So a month ago, that's what this is, January 9th, there was about a 63% market implied probability that the Fed would have dropped rates by March. Look at that today, and it's only about a 17.5% chance. Okay, so we went from over 88% chance the end of December to 63% a month ago to only 17%, 17.5% chance today. Pretty massive change. Even if we look at the May, projecting out what the policy will become this May at the Fed meeting, back even just a month ago, there was only a 7.5% chance that the Fed would stay at current rates of 5.5 to 5.25 to 5.5. Now those probabilities are up to 40%, and you can see a month ago there was almost a 50% chance that the Fed would have dropped by 0.5 percentage point down to here. Now that probability is only about 9%. So a pretty dramatic resetting of expectations by the market, and we're starting to see that play out in asset prices. So let me show you another different chart here. So the stock, we know the stock market rallied at the end of October through the end of the year. So did bond markets. But I want to show you a couple glimpses that are really interest rate sensitive. So this is showing a chart of the 10-year Treasury bond yield and the US dollar. Okay, the US dollar index here is in orange, and the Treasury yield, 10-year Treasury yield, is in blue. So you can see at the end of October here, end of October here. So this is October 27th. Both the dollar and the 10-year Treasury rate dropped pretty significantly, and that gave a massive tailwind to things like stocks and bonds and things like precious metals and commodities. But at the end of December, you can see both the dollar and the yield on bonds have spiked quite a bit higher. And that is when the market started to reassess and reprice in the dramatic changes that we're now seeing. So, you know, this has pretty profound implications. And I think what folks in the markets have lost sight of is just how utterly off the charts rare the interest rate environment has been for more than the last decade. So I want to go to this chart here that looks at the federal funds rate going back over a long course of history. This is right off the Federal Reserve's website called FRED, Federal Reserve Economic Database. I think it is economic data. And basically what you see here is where we are right now at 5.33%. While it seems high relative to certainly the last decade plus, where interest rates were driven down to zero, literally zero from most of this period, it's actually quite not so high when you look at it through the lens of history. In fact, you know, all the 90s and 80s, the interest rates averaged well above that. It's only this post-bubble, tech bubble, post-housing bubble, where the Fed intervened to dramatically and artificially lower interest rates, that this current rate seems high. So I think the market is starting to reset those expectations. And you know, I think the real key here is so I think the question on the table, certainly for we as investment managers and for folks looking after their own money, is if and when the Fed does pivot and start to lower interest rates, is that a good thing? And our take on it is it's probably not going to be a good thing, because it's probably going to be a reactionary panic move by the Fed to a stock market and or economy, or both, that are in a free fall or certainly a significant retraction. And I want to just illuminate one chart to kind of point that out. And this is a chart that we have shown before, but I'll show it again. And this is right off of our Twitter page. This is a chart we posted, and it basically shows this blue line is the federal funds effective rate, and this line here is the S&P 500. And what you see here is red dots when the Fed raises short-term interest rates, and green dots when it drops short-term interest rates. And what we know from a century of history is that the key determinant as to whether interest rate pivots or drops are good or bad lies in valuations. Typically, when the market is significantly richly valued, like it is now, the market actually doesn't cheerlead rate drops. And in fact, if history is any guide, oftentimes sees elevator drops downward. And the reason for that is those rate declines are oftentimes a reactionary, desperate attempt to stop a market sell-off. And that's what we saw here in the tech bubble here and the housing bubble. Very significant, over 50% declines in the markets here, despite an aggressive cutting campaign by the Fed. Obviously, we'll keep watching things. This is a constantly evolving situation. We think the Fed is got a very challenging job ahead of them in terms of setting interest rate policy. And while folks want to focus on whether they should raise or stay put or drop, and are looking at that with a laser focus, and potentially pointing out a policy error, our opinion is that the policy error was made a long time ago, and that was in keeping those short-term interest rates so low for so long and fueling what by any historical measure would be judged as a massive bubble in asset prices that has continued to expand. And I think it's going to be a process. We've talked recently about the very pointed strength in markets despite these overvaluations. And so we've got some tricky times ahead, and of course the interest rate environment here will play a big role in determining what goes on there. So that's all I want to share for this timely take. I do want to call folks to action here to subscribe to our YouTube channel to get alerts for when we post this and other more in-depth conversations. And also follow us on Twitter. That's where we like to just put out some of our own or retweet some other really impactful graphics and analysis that we find germane to what we do for our clients. And our Twitter page is at New Harbor Fin, F-I-N for financial, at New Harbor Fin on Twitter. So thank you for watching, and until next time, I wish you a great day.